all it remains for me to do is to bring on Iain Pyle, who's going to talk to us about Shires Income. Iain, are you there?
Hi there, Matthew. Can you hear me?
I can hear you loud and clear, sir. So thanks very
So
much for joining us today.
See me. I think I can only hear me and not see me, which is probably no bad thing. So hopefully that works.
Excellent. Okay. So I should say that obviously Iain is a investment director in the UK and European equities team at Aberdeen. He's been doing that since 2015. Iain is lead manager of Shires Income, deputy manager of Murray Income, and of Aberdeen Equity Income Trust as well. Iain, can you just give us a quick sort of elevator pitch, if you like? Just spend a few minutes talking sort of through Shires, which we're going to sort of discuss today. Just for those that perhaps need a bit of a refresh, or perhaps aren't or less familiar with the fund.
Sure thing. So Shires is a UK equity income trust, basically. And the main goal we have is to deliver a high level of income, which is sustainable and resilient through cycles. So at the moment, the trust provides about a 6% dividend yield, and we've been growing that modestly over time, and there's over a year's cover of dividend and revenue reserves. So we should have a high yield, very competitive with the market, competitive with cash and bond returns, and that should be very defensive. But we also aim to maintain that potential for capital growth over the longer term. And we have quite a diversified equity portfolio with plenty of growth and SMID cap exposure in there to provide the growth. I think what differentiates us from most of the UK equity income trusts out there is primarily a fairly material holding in preference shares. So about 20 to 25% of the portfolio is in preference shares, and they give us a very high stable yield. So all the preference shares we hold yield above 8% at the moment. They are perpetual and they sit above equity in the capital stack. So you have a big block of the assets that do the heavy lifting on yield and allow us to have a much more diversified equity portfolio. Then we also hold some overseas shares for diversification, and we have some small option writing program as well, just to enhance income. And the overall aim is that we have that high yield. It's very defensive, but over time we have plenty of scope for good capital growth out of the portfolio as well.
Excellent. Just sort of on the preference shares, is that something that you manage yourself, or is there a sort of dedicated team in Aberdeen that helps you with that?
So we manage it ourselves. You're looking at about 7 or 8 positions, so it's not a huge portfolio, and the turnover on them, understandably, is very, very low. So we rarely buy and sell them, partly because they don't get issued very often anymore. It's quite a narrow market, and if you have them, you tend to want to just hold on to them. So it's an easy bit of the portfolio for us to manage. The preference shares are issued primarily by companies we cover as part of our equity coverage.
Yeah.
In any case. So it's very straightforward.
So would you tend to see, say, the sort of equity and the prefs in your portfolio? I'm guessing if you like the equity, you probably like the prefs as well. Is it sort of further up in the capital structure?
I would say it's not quite that simple. They tend to move quite differently. The preference shares obviously move much more closely with fixed income instruments. Yeah. And there are not that many companies that have issued or still issue preference shares. So the overlap is very limited. Standard Chartered is the only one in the portfolio where we have both preference shares.
How much of the portfolio is in overseas?
We have a 10% limit as a percentage of the total portfolio, and we tend to be around that level.
And is that a sort of similar situation? You manage that yourself, but at the sort of same time, I'm guessing there's plenty of resource in Aberdeen that you can fall back on. Is that a sort of fair description?
Exactly right. Yeah, we manage it ourselves. We'll meet the companies we hold there, just as we would the UK names, but we do have access to a big European team, plenty of other European fund managers out there and European income managers who we can chat to. We can steal their best ideas, and that certainly makes it easier.
Okay, that sort of makes a lot of sense. Are there, so obviously the whole Aberdeen ethos tends to be sort of very, bottom up, company specific, sort of etc. Are there sort of any investment themes though that you could say sort of run through this at all?
So I think thinking about the equity positions, what we look for is obviously a good level of income, And that doesn't have to be a high headline dividend yield today. What we really look at is a combination of dividend yield and dividend growth over time, because that is generally what works in income investing. All our back testing would prove that, and it keeps us out of the kind of high yield dividend traps where you can make a nice income year one, year two, but over time the only way is down. And the other thing we focus on is the quality of the businesses we invest in. So that's a bit more of a nebulous concept, but when we talk about quality, what we're looking for is good businesses, good market positions, high barriers to entry, strong balance sheets, and management teams that we rate and trust. And those things come together to give better growth prospects and I think a higher degree of resilience through cycle for the cash flows and therefore the income component from those stocks. So that kind of combination of income and quality is what we're looking for in the positions.
Yeah. And what sort of yields are you getting on the sort of underlying equity positions? And is it sort of fair comment that presumably with the yield that you're getting off of the prefs, that allows you to sort of do as you've described and go for stuff that's perhaps a little bit less yieldy today, but will give you the growth and presumably the sort of valuation uplift over the longer term?
Absolutely right. Yeah. I mean, there's a chart we have in the marketing deck where we kind of split the portfolio down into yield buckets. 1 to 2, 2 to 3%, etc. yields. And the preference shares sit in the highest yield bucket, but once you take them out, actually the portfolio is pretty much evenly spread across those different yield buckets. And there are things in there which are nice, high single digit or even double digit yields where we've got high confidence that they'll be maintained and grow. But there's plenty of things down in the market or below market level yield where we think we'll get good capital growth or income growth out of those. And we try not to limit individual stock positions based on something like just the headline dividend yield. We'll try and keep the eye on the horizon, look at what the overall portfolio yield is, make sure we're delivering overall income growth to the end client, but we can do that in quite a nice diversified way within the portfolio.
Yeah. Okay. I mean, we should mention quality a moment ago. When I sort of think of, the way Aberdeen portfolios are described, that's a sort of word that sort of comes up sort of regularly, and it sort of tends to suggest that perhaps in more difficult times that they are sort of more resilient, or you expect them to sort of be more resilient. I mean, I sort of wonder whether because of that, perhaps the sort of portfolio is perhaps sort of a bit more expensive on average. Is that sort of fair comment? Is there anything that you can point to argue that one way or the other?
Gosh, that's a good question, actually. I haven't looked at our headline PE to kind of bring it to one number. But if we screen on style across the portfolio, then we are ahead of the market on dividend yield, unsurprisingly. And we're ahead of the market on growth. And we are roughly neutral on value. So it is not an expensive portfolio. And I think maybe the competing forces of looking for capital growth and also yield today means you kind of balance out that that driver. It's not too expensive a portfolio, which I think is probably a good thing right now. I do think, if we wound back 2 years, then at a period where growth and quality were kind of synonymous with each other, and after a long period of falling bond yields, you had both a high growth premium and a high quality premium in the market, then we quite aggressively pushed into more value positions at that point in time. So we sold a lot of the more expensive things there, and we've been kind of buying back some more expensive bits of the market at cheaper prices over the last year or so.
Okay, that makes a lot of sense. Just, I guess, to follow on from that fleet or theme slightly, if you say sort of look at the portfolio, you're saying that there's a sort of growth bias. There are sort of slight growth bias there, but obviously, how these things offset. I mean, what might you be typically expecting from sort of across the portfolio in terms of, say, earnings growth and dividend growth, and would your sort of portfolios tend to screen perhaps a bit more growthy in terms of those than, the market or, the benchmark?
In terms of earnings growth, I think possibly slightly ahead, but we are not trying to compete with a US tech fund or a NASDAQ tracker with this product. Yeah. The focus is on generating resilient income, not on delivering growth. And in all honesty, we're getting a bit of a growth boost at the moment because some of the traditional income sectors like banks and energy are seeing earnings growth, and they're kind of screening as more growthy than they actually are over the long term. So I wouldn't want to overstate the growth.
Yeah.
Then equally, we're getting some really nice high growth companies into the portfolio as well to fill that gap. In terms of income growth, I think if we do kind of mid-single digit percentage income growth year on year, I think that's good. I think we can do a bit better than that. The market tends to underestimate the potential for dividend growth over time pretty consistently. But at the moment, we're seeing that dynamic in the UK market where post-pandemic and a lot of dividend cuts, companies are shifting from paying a high dividend per share to doing more share buybacks because that is more and more counter-cyclical. It's more flexible than just having a fixed dividend per share that you might then need to cut. And that maybe limits the dividend growth a little bit, but we tend to think about total distribution yield, i.e. dividends plus buybacks, is what we're getting out of the companies. And I think that the outlook for that is pretty good. UK companies are not over levered by any means. Payout ratios are quite low, so yields can continue to grow, I think.
Okay, that's super. Just looking at this sort of slide here, it does say obviously you've got the position Aberdeen Smaller Companies Income Trust, obviously provides access to the higher growth. How much of the portfolio is that? Then can you just perhaps talk a little bit about that?
Yeah,
I'm guessing presumably there's no double counting of fees.
There's no double counting of fees. Yeah, I think that's a point you've always got to make because that would be a bit cheeky. So that has historically been a reasonably material position in the portfolio. It's the largest single equity holding, and it's about 10% roughly of the portfolio. It has been a very good long-term performer for us, but it's struggled a bit in the last few years as a strategy which is very focused on momentum and growth has not been that great, and as liquidity has come out of SMID caps in the UK, as we know. I think it's well known that we're going through the process now of a proposed merger between the two funds, so we will hopefully take Ascot into Shires, dependent on shareholder votes. And I think that will be a good thing for Shires because we will avoid the illiquidity of that position. We will avoid the impact we can have on performance as that discount widens or narrows over time. And it will give us an ability to have a exposure to small caps that we can manage more closely ourselves. And I think it simplifies the portfolio and makes things a bit clearer. It will also grow the asset base, and I think there's the nice simple benefit there of just spreading costs over a larger asset base, which is beneficial for end shareholders. Yeah, no,
that actually sounds like it makes a lot of sense. Perhaps it hasn't been sort of thought about yet, but will that effectively remain as a separate portfolio within Shires? And sort of how will it be managed? Has anybody had come to a view about that yet? Or
so what we've said is that the overall portfolio will be managed as Shires is today. And what we want to make sure we do is keep that small and mid-cap exposure that we've got, because it's a great source of growth. It's a great source of really underappreciated companies in the UK at the moment because there's not a lot of coverage. And the Aberdeen small cap team is really good. So we've got some really good experience and expertise there that we can take advantage of. I think the difference with doing that directly rather than via the Smaller Companies Trust is that we won't want to run too many positions. If we had 50 equity positions, they had 50 equity positions, there might be an overlap of 15 to 20, but we wouldn't want the total number of equity positions getting up to 80 or so. We'd want to rein that in and concentrate the small cap exposure in the best names that best fit our process within the portfolio.
Yeah.
So I think that's the change, and that gives us a little bit more control for myself as a manager of Shires, and it allows us, I think, to just concentrate in a little bit on the names we like most within the small mid-cap space.
Okay, excellent. So another thing that you do is obviously there's the option writing program that obviously enhances income. I'm presuming that's sort of things like covered calls, etc., etc. Perhaps could you just talk us sort of a bit through that, please?
Yeah, I think the option writing program is always something that sounds complex, but in reality is very simple for us. And I wouldn't want to overstate the importance of in terms of income. It's a nice tool to have in the toolbox, I would say. So if I was to give an example, let's say we have a big position in AstraZeneca, and AstraZeneca's gone up pretty consistently over the past 5 years. It's been a great performer, and we want to think about trimming the position. We could write a call at a price above where the market trades today, and we will earn the option writing premium on it. And if the shares go up above that price, then the option will execute and we will effectively sell some Astra at that price. If the option executes, it will be below the market price on that day, but that's fine because we would have sold it below that price in any case. And if the price goes down, nothing happens, we still earn the option writing premium, which is not money for nothing, so we're taking some risk in the option writing, but it's as long as we are writing options that are consistent with how we would deal in the equity portfolio anyway, we're not taking any additional risk there. So it's a nice way to add a little bit of income at the margins.
Yeah, and presumably these are quite short-dated options, are they?
Yeah, we usually look about 2 to 3 months out in the future. If you go beyond that, obviously the risks change, and equally, if you go into like maybe just 1 month, then you tend to find the premiums you're earning are not as attractive. So that's the kind of balance we have.
Yeah. No, that makes a sort of lot of sense. I suppose, is it worth perhaps talking about a couple of stocks that sort of perhaps would give us a bit of a flavour for the kind of thing that you do?
Yeah, sure thing. Why don't I talk about a couple of things we've bought recently? And there's a slide in the deck, if people can see it on the screen, which I think is slide 10 or so, which has a little Venn diagram of all the things we've kind of added in the last year. So if you can pull that one up.
No, I'm going in the wrong direction. So
here we go. We'll get there. That one.
This one?
I can just see the appendices slide, but I think you'll get there. I think it's the one before that one. That one. Up.
This one? Sorry.
So it should say portfolio changes, and it should have kind of a diagram with 3 circles on. I can see it now. So hopefully
perfect. Sorry about that.
So I love talking about stocks, so I could pick any of these and talk about them quite happily. But if I think about the most recent purchases we've done that I think are, at different ends of the spectrum in terms of what we're trying to deliver, then I'd go for maybe IP Group and NL, because I think they show you interesting things about what's happening in markets and how we have a kind of barbell approach on the positions. NL is the easier one, I think, to talk about. We added it fairly recently, and the obvious attraction is it's defensive. I think equity markets look quite fully valued at the moment, and I'd like to have some defensive exposure. It's got a just over 7% dividend yield, which is attractive, and because it's a regulated utility, that dividend yield is very, very safe. We can pretty much rely on it. That's so far so good for utilities and doesn't really necessarily get you out of bed in the morning. But I think what is interesting for long-term investors is the undebatable need for Europe and the UK to invest significant amount in clean energy infrastructure and storage over the next 10 to 20 years. And a company like NL, which has a meaningful position in renewable capacity and in distribution and storage within Italy, a bit of Spain, a bit of US, it almost inevitably has to grow its capital base and earn a competitive return if you have a long-term time horizon. And that supports dividend growth over that time, and will be paid pretty well to wait, and the risk is relatively low in it. So that it's a nice way to get, I think, if you've got a long-term time horizon, that kind of utility area exposed to clean energy growth is really attractive. So SSE is one we've had for a long time as the UK name that's most exposed to that, and it's done very well. We still really like it. That's not going to do anything particularly quickly, and hopefully the error bars on the outcomes are not massively high. But I think if you come back in 5 years, it'll be worth more, and if you come back in 10 years, it'll be worth more again. IP Group has much higher error bars on the outcomes. There's no doubt about it. So this is a company which invests in early stage technology companies, and it has a very strong relationship with UK academic institutions. So it takes a lot of projects out of them and helps commercialize them and make them profitable. And it's been involved in the development of a number of successful companies like Ceres Power and Oxford Nanopore, for example. And it still has a big holding in Oxford Nanopore now.
Yeah.
It has, beyond that, a really nice diversified portfolio of very high impact early stage tech companies spread across biotech, high tech in a kind of IT way, and energy and clean energy. So things like fusion power and hydrogen generation. And within the portfolio, it has a number of things which are really meaningful, maybe not the highest chance of success, but high reward if they are successful. And a diversified portfolio of those things can deliver very good returns. In an income fund, it gives us a nice way to get access to really high growth opportunities. And there's a number of really meaningful potential catalysts over the next 12 to 18 months. What made it really interesting for us was that we've kind of observed the boom and the bust of private capital valuations over the past few years from one step removed, and kind of enjoyed the realization that actually interest rates should not be 0% and valuations should reflect that. And that's caused, I think, a lot of valuation opportunities to open up in that market. An IP Group, it trades at about a 50% discount to its published NAV. And we've done a lot of work to get comfortable with how prudent that asset valuation is. If you take out the listed stakes, such as Oxford Nanopore, then the remainder of the portfolio trades at an 80% discount to the current published asset valuation. And that gives you a pretty big margin of error on things not working out for the company. You're already saying 1 in 5 things is going to work. And then they're only going to maybe work at the low level of potential. So we see pretty material upside potential in the business. I think the discount can close, and I think it's a really nice way for a UK income fund or any UK fund to have really exciting growth exposure within it. And it pays about a 1.5% dividend yield, which is not massive, but it's helpful, right? It's a good way to get exposure to that sector.
Excellent. Okay. Just sort of conscious of time. We've had some sort of questions come in by email, which I think we should just worth going through. One of them was, can you talk us through the process of integrating the ASCII portfolio? But I think we've already covered that. There is an interesting one. How do you balance your sort of ESG positioning with investments like Anglo American, BP, and Rio Tinto?
Yeah, I think that's such a great question, actually. And I am a big believer in the importance of ESG and I'm a big believer, one, because there's an imperative for all of us to engage with it, but there's also a strong belief that good companies engage with ESG in the right way. They are forward thinking, and that is going to deliver the right outcomes for the companies and for us as end shareholders. So good ESG is good business and is a good investment. The companies we hold, I am very much in the engagement camp when it comes to ESG. I don't really think we should divest from companies just because of what sectors they operate in. But we should, if we're going to hold them, make sure we do our homework, make sure they're good operators, and make sure they do things in the right way. So Rio has done a lot of work over the last 5 years to reduce emissions and be a better ESG company in its space. BP, I think, has been well recognised, is still primarily an oil and gas company, but is also a big investor in renewable energy, in EV charging, in hydrogen, in CCS, in so many things which will be beneficial for the world. And they have very strong targets on carbon reduction as we go forward. So I find that's good. My ability as an engaged investor to meet the BP CEO and tell him that these things are important to me is much more powerful than divesting from it. And we do look at companies which might screen as difficult. One of our biggest holdings is Diversified Energy, which is a gas producer in the US, and they have had issues with methane emissions from well stock that they have acquired over the years. But we've had a really great engagement process with them where they've taken meaningful action on reducing emissions, and that's a company that's improved vastly over the last 3 to 5 years. And that's a great example of the power of engaging with these businesses and getting improvement.
Yeah, excellent. Okay, got a sort of question on the portfolio here. So somebody's points out that real estate is a sort of significant underweight, but that you sort of added to supermarket income REIT. The sort of question is, do you see sort of current market weakness, presumably in property, as an opportunity to add exposure to that sector?
Yes. So if we'd gone back 2 years, real estate probably would have been an overweight in the portfolio because it's a good source of yield. The REIT structure means you're going to inevitably get income out of these businesses. Around, I guess, late summer last year, probably, we significantly reduced real estate exposure because that dynamic of rapidly rising rates and some economic weakness means that it just gets much harder for these companies to earn that gap between rental yield and the cost of debt, which creates a risk for the income generation of businesses. So we sold a lot of our real estate positions last year. We have just started to edge back into real estate. So Sirius Real Estate is the one we bought probably 4 or 5 months ago. And we're just starting to take that view that we are much closer to the top of the rate cycle than we are to the bottom. And for the good businesses with good management teams, differentiated estate, and where supply demand in their area is in their favour, I think they're interesting. We bought back into Sirius just after they actually put up the dividend, which was a good sign of confidence for us. That's one we've owned before and we got out and back in. I do think real estate is definitely interesting. It's always a sector where you've got to buy it when it's the hardest to do so and sell it when it feels the hardest to do that as well, because it can be cyclical. I'd probably like to see rates peak and start to come down. Given I'm moderately bearish on the market and the economy, I feel I don't want too much real estate risk right now. But definitely we would be inclined to add selectively in that sector rather than sell at the moment.
I suppose sort of related to that, are there any sectors that you perhaps within real estate find more interesting than others?
Within real estate, I think it's tough. I think we probably had a preference for logistics and warehousing where there's a strong structural demand growth and limited supply versus office space, for example, where demand is a bit uncertain and there's more need to reinvent the estate and deliver a premium offering to make it compelling.
Yeah.
But in that space, good management teams and good assets will always do well, independent of what subsector they're in.
Yeah. Okay. I've got a sort of couple of questions here that are sort of related to gearing. Sort of first one is, and I'm not sure, I can't remember off the top of my head, sort of what the gearing is sort of relative to history, but I suppose there is a sort of element of that's partially offset by the allocation of preference shares. But the sort of question is, gearing is currently quite high at 20%. Are there any concerns here given the rising cost of debt? And then the sort of other question that kind of sort of overlaps with this a bit is, so what is your process for, I think it's basically really sort of allocating capital sort of versus new investments versus buybacks or paying down debt?
Yeah, so let's start with leverage. You're absolutely right that the gearing we have is there to fund the preference shares. So leverage is about 20%. That's optically quite high, but it links up with the percentage in the preference shares roughly.
Yeah.
And our view is always that if the cost of debt is lower than the yield we're earning on the preference shares, then that's okay. We're making income off that trade. And over the long term, gearing is one of the great benefits of a closed-end structure, right?
Absolutely.
And it helps us deliver better returns over the long term. So very happy to have it. We try not to be too clever on the level of gearing, and we actually haven't really changed it. I think unless you need to, that puts you at a risk of doing things at the wrong time. And in an income trust, if we cut the gearing, we have to sell positions and reduce the income generating capacity of the trust. So we tend not to play around with it. We fortunately, or I'd like to say skillfully, fixed the debt cost last year for 5 years. So we're seeing the cost of debt go up in the market. I hope it will come back down before we next need to refinance the debt, fix that. So that definitely helps. But I think the overall message is it's broadly funding the preference shares, and it's not something we take too much risk on.
Okay.
And then in terms of capital allocation, historically we have not done buybacks because we want to try and grow the trust from its current size, and also because fortunately we've generally traded at a very slim discount or at a premium to the valuation. So there hasn't been that opportunity to do a buyback. The last month or so, we've seen that discount widen out, and it got above 10% last week. So we actually instigated the first buyback program I think the trust has ever done this week. So we're making some buybacks just to close that discount a little bit.
Yeah.
Whether that's related to the combination with ASCII or not, I don't know, but it's an opportunity to just buy back some shares at that kind of discount, which is higher than it should be, obviously, in my view.
Yeah, absolutely. Okay. Got a sort of interesting question on the portfolio here. It says there was a significant increase in energy and financials throughout 2023. Do you expect this to remain in place?
That's a good question. I wouldn't say that increase was necessarily in 2023, but
I did wonder about that actually.
Yeah, I think we, as I mentioned earlier, we definitely did push into more value sectors in 2021, and financials and energy were two of those sectors where it did increase the weight. Energy, simply shares were very attractively valued. Some of the structural trends supporting energy prices make them attractive, and we had dividend cuts in some of the big energy companies, which meant that you were back to a level of dividend growth as well as a sustained period of buyback activity, which I think is likely to continue. So happy to overweight that sector. And then financials, obviously we were getting into a rate rise cycle at last, and I think people get a little worked up about us getting to peak rates and then banks need to come down from there. I think the market is yet to realize that after 15 years of declining rates and near zero interest rates for much of these banks, the business model didn't really work. Going forwards, interest rates are not going to be zero. They might be 3%, 3.5%. But in that regime, a more normalized interest rate regime, banks are back to being good, profitable businesses which can cover their cost of capital and distribute a high level of income on a sustainable basis. And most of the UK listed banks have de-risked so substantially since 2008, 09 that you are not looking at the same level of risk. The market doesn't value them that way, but from our point of view, they're quite attractive. So hence, that's why we've taken on a bit more financial exposure as well. And I think all those things hold true. I might have a slightly bearish outlook on the market, so we've got to be careful where we add, and we've actually kind of de-risked our financials exposure a little bit this year. So moving from higher risk banks into lower risk positions, like we sold Barrag in Europe, which was probably at the higher risk area end of the market, and put it into ING, which is at the lower risk end. And I think that's how we want to play it. We want to get away from pure rates leverage into more stable businesses with sustainable, decent return on capital, which is
So I've got a question here that's related to that. It says, so have you been adjusting your cyclical exposure in light of deteriorating macro conditions, particularly in the UK and China? I think probably the sort of UK is arguably more relevant here. Have you sort of got any comment on that?
Yeah, I mean, we don't actually have an awful lot of cyclical exposure if you think about that as kind of industrial cyclicals. But yeah, I mean, you could equally split out consumer cyclicals and financial cyclicals as well, as all on different cycles, all moving in slightly different ways. I think we've definitely added more defensives because of that. And I think if you looked at that chart that's up there, what is really economically sensitive in there, I think you would probably say Sirius, but real estate probably is troughing as a cycle and getting better. You would say Anglo-American is, but we bought Anglo's having sold BHP, basically switching between the two. And you might say that HSBC is cyclical, but I think the kind of longer term structural trends there for interest rate normalization and a broadening of economic growth in East Asia favor it. You've just got to kind of be happy to hold it through cycles. And at the moment, you're seeing a bit of negative China sentiment, which impacts it, but long term, I think that's absolutely fine. The others are generally pretty defensive, and Enel, Engie, Oxford Instruments, Games Workshop, Convatec, these are all pretty defensive businesses which are not economically sensitive. And we do like that, when the growth bucket there is macro independent growth, because we want things that can generate their own thrust to move up through time, independent of just riding the cycle.
Yeah. I mean, this is a sort of low turnover, I'll spit it out, turnover portfolio. I mean, how long do stocks tend to stay in the portfolio on average? Do you have a sort of feel for that?
I think the average would be probably 7 years, roughly. Since I've been managing it, we've increased the turnover, and we are trying to be more nimble about getting in and out of stocks and recognizing when the valuation is right. So it is low turnover. I think it screens as very low turnover because the preference shares as a block are very low turnover, and historically the ASCII position has been very low turnover. So that has been at times over a third of the portfolio that effectively is nil turnover. So that makes it look more snoozy than I think it actually is. I think the equity portfolio, we are more active in it than we are. But
that makes sense.
That focus on quality and long-term investing is still there. So some things will be there for a long time, and I hope they're there for a long time. But there's examples of things in recent years that I think we would have held forever, and we've tried to be more active. So DECRA was a great example of one probably a lot of people will be familiar with, and that like a veterinary pharmaceuticals business in the UK. We held it for a long time. We sold it in 2021, near the end, where we just thought the valuation was too high. We bought it back near the end of last year, November last year, when it had derated by about 50%, following the kind of fall in growth stocks. And then it was subject to a bid this year, and we've sold out again, having made, I think, a nice 30 or 40% profit in the short term. And I think that's, I'm giving you an example which worked very well, obviously, but it was a nice demonstration, I think, of that willingness to say, okay, just because something is a good quality company where we like the business, and Depker ticks all the quality boxes in terms of return on capital, balance sheet, management team, at some point that is fairly valued, and it's time to find newer, better ideas. And I think in an income trust, you're particularly motivated to do that because you're searching for better income. If the yield is compressed, time to move on and find something else. So we're trying to always have that in mind. When we buy a position, we're thinking, where can that get to? Where should it be? And at what price would we not buy it? And if we get there, time to think again.
Excellent. Right, I'm just conscious of time because the hour's almost up. I guess sort of before we go, you've given us a really good overview of what Shires done. Sort of thanks for that. But just before we go, I mean, why now? Would you say?
Why now?
Yeah.
I mean, honestly, I think what a great time. I think the UK as a market is so obviously undervalued at the moment, and you will all see multiple charts showing that, and how the valuation gap to other developed markets is super high. I think that's all true. For engaged investors in the UK space, it feels like it is such an opportunity-rich environment because coverage and engagement with the market has declined. The yields are high. We're seeing lots of good quality companies on low multiples. And I think even before you look for a re-rating of the market, there's a huge argument right now to buy something which is, I mean, the UK market has actually done pretty well in recent years, but buy a market at a valuation discount. One thing everyone should have learned in 2021 is that if you just put all your money in growth and tech, that might be great, but it's much better to have a diversified portfolio and have some things that will move in the opposite direction. And buying UK income right now is super attractive. Buying something like Shires, where you will earn a 6% yield, which is competitive with cash or bonds, and have lots of potential of capital growth over time, I think it's a great time to do it. So
excellent.
That's how I feel.
Okay, well, thank you very much. I'm sure we'll get you back, in, I don't know, 6 months, 12 months time, just to have another chat again and talk about sort of how it's how things are going. But sort of thanks for that today. And I think we'll wrap it up there. Just for the benefit of our sort of viewers, as it were, just to sort of let you know what we've got sort of coming up. So next week we've got Andrew McHattie coming on to sort of do his usual monthly roundup, and the special guest is going to be Phil Kent, talking about GCP infrastructure. 8th September we've got Prashant Kimka from Ashoka White Oak Emerging Markets, so that'll be very interesting because that's sort of relatively new launch, something to sort of grow there. And then 15th September we've got Tom Williams from Dow Renewables and Infrastructure. 29th we've got Andrew Jones from London Metric Property, and then to round up September we've got Carlos Pardenberg to come and talk about Mobius. But thanks everybody, and thanks to Iain, and wish you all a very happy, very enjoyable bank holiday weekend. Thanks for now. Bye.